Okay, we are now live. So as we wait, probably I'll give it 1 minute or so, and we have our attendees flowing in. Thank you everyone for joining us today. Okay, I'll begin. So, hi everyone, this is Hannah again, once again from Lloyd's Asia Market Development Team based here in Singapore. Welcome to the final week of our Academy's APMEA Emerging Risk Series 2025. Whether it's kickstarting your day or mid afternoon now or winding down your evening, we appreciate you being here. And over the next 1 hour, we'll be exploring how shifting tariffs, regulatory developments, and other economic trends are shaping the global risk environment today. So I'd just like to share a quick disclaimer before we begin. The views expressed here by our speaker are their own and do not necessarily reflect those of Lloyd's Corporation as well as service companies. This series is intended for educational and informational purposes only. Please also remember that nothing here constitutes as a formal piece of advice or is an official Lloyd's position. Each webinar will qualify for 1 CPD hour, so stay with us until the end and complete a feedback form to receive this, and also use the Q&A function to engage with our speaker and also ask a lot of questions throughout this meeting. So without further ado, I'd like to introduce our speaker. He is none other than Shailesh Kumar, and he is the head of the Hartford's Global Insights Center. He oversees economic and geopolitical research to provide insights as well as risk advisory services to the firm's leadership, underwriting departments, as well as clients and brokers. Before joining the Hartford, Shailesh was at Eurasia Group, a geopolitical risk consulting firm, and he served as an economist at the US Department of Treasury. And earlier in his career, he also worked at various investment banks as a global macro investment specialist. So now I'll hand the time over to Shailesh to kickstart this sharing today. Thank you.
Okay, thanks. Thanks for having me here today. And I wanted to start off by perhaps telling you a bit more about my team at the Hartford and what we do. And then I was going to get into some of our views and talk about the geopolitical landscape, what's happening with tariffs, and where we see some of the economic indicators heading forward. So my team is at the Hartford, as mentioned. I run what's called Global Insights Center. We do research into the global economy, but really with a focus on the US economy, given our footprint, but we do global as well. And we also spend a lot of time on geopolitics and the intersection between the two. We do forecasting, we figure out what this means for where the world is headed, where different economies are headed, and then ultimately what does that mean for the insurance sector and different lines of coverage that we provide. A lot of my time is spent with our internal underwriting units and our leadership department. We advise them and we brief them. But I also spend quite a bit of time with our external partners. So our brokers, our clients, our agents, our policyholders, partners in the industry, and which is why I'm here today. If you don't receive any of my material, please reach out to your counterpart at the Hartford, or you can email me. It's shalesh.kumar@thehartford.com. And we do have some content that we put out into the external space. Or you can go to our website, which is thehartford.com slash backslash, sorry, GIC. So thehartford.com backslash GIC. And you can also sign up there as well and read some of the material we've put into the public domain. All right, so today I was going to talk about the geopolitical landscape with a real strong emphasis on tariffs and what do we see happening. But I did want to start off with what's happening with the U.S. economy. Now, I do appreciate that a lot of the folks dialed in are in the Asia region and may not be based in the U.S. Yes, but we do spend quite a bit of time focusing on US. I think it's an important place to level set because a lot of the policy decisions, of course, are coming out of the US right now, and they're a reaction to the US economy. And so we do want to just ground ourselves with what's happening to explain why some of these policy developments and policy shifts may be playing out at the moment. So the first place I always like to start is by talking about what's happening with labor conditions in the US. And at the moment, the labor markets are what we refer to as being in balance or normalizing. And to put this in context, right before COVID, the unemployment rate, which is how much unemployment there is in any country, the unemployment rate in the US was 3.5%, which was a very, very low number. You have to go back to the late 1960s to find a number that low. And then right after COVID, it was right back to 3.5% is again. And one of the reasons for this is that there's a structural element in the US that we believe, specifically a shortage of workers in some cases. We have an aging society in the US, and some people left the workforce during COVID. And so that was one of the reasons why the unemployment rate was so low. And then, of course, also there was a lot of demand for labor. And so one of the data points we track is what's the number of open positions relative to the number of available labor. And that number was running at 2x right after COVID, meaning that there was a lot of demand and not a lot of labor that could fill it. Since then, the unemployment rate has moved higher. It's moved up to 4.2%. And the ratio, that same ratio I've been alluding to about how many open positions are there relative the number of available talent, well, it's come down to 1x. So that's often why we say that the labor markets come into balance or why it's normalizing. It's still healthy. There's still very relatively low unemployment rate. It's just that it's gone up slightly. And one of the byproducts you get when you have a shortage of labor is that, and relative to demand, is that you get something called wage inflation. Like anything else, if you want something more of it and you don't have enough of it, the prices will go up. So wage inflation, which is how much were wages rising or how much do they rise in any given year, that number was about 2% before COVID. Right now, it's running at 3.8%. So that means the average American is getting a 3.8% wage increase on average across sectors, across the country, and across age groups. So that's a relatively high number. And again, it's a byproduct of the relatively tight labor market that we have right now. So that's labor. Second thing to consider is what's happening with inflation. And this gets more directly to our tariff conversation. So one of the issues during COVID was that inflation globally, but in particular in the US and in the Western world, really got high. And the number specifically was 9.1%. So when we think about inflation, it's the consumer price index specifically that I'm talking about. Every country has their own inflation gauge. Some of them call it wholesale price index, consumer price index, and there's other data points you can look at. Even in the US, we have multiple ones, but I'm just talking about CPI here. Consumer price index got to 9.1%. That's a really big number. Historically, it used to be two or less than two. 2% is what a lot of developed markets look for in inflation. You don't want to be much higher. And in the case of the US, the Federal Reserve targets 2%. So if inflation gets much higher, they start to raise rates. And if it gets lower, they lower rates. So during COVID, that number got to 9%. And in response to that, the Fed raised rates. Since then, inflation has moderated. So in the last month, it came down to 2.3%. So that's a much better situation, obviously, than where we were just a couple of years ago. The issue, however, is the compounding effects of inflation. In any normal scenario, as I said, you want to see inflation of around 2%. If we had had 2% inflation consistently here in the US over the last 10 years, what would have happened is the compounding effect would have resulted in prices rising by about 15 to 20% over a 10-year span. And again, that's a very normal phenomenon in economics. You want prices to rise, you want them to rise in a healthy balanced manner. But because of that COVID era spike in inflation, when inflation got up to 9%, the cumulative effect is that prices for a basket of goods and services are up 35.6% since 10 years ago. And that's what people feel. So even though I, as an economist, are telling you that inflation is normalized and it's coming down to 2.3%, the fact is that the way people feel it is much different. And because of the COVID era spike and the compounding effects of it, most Americans are thinking about the fact that prices are up over 35% over 10 years, and that becomes a political issue. I'm bringing this up for two reasons. One, to talk about what eventually I'll talk about what will tariffs potentially do to inflation going forward, but two, to explain some of the context of the dynamics at play. And because of these disruptions in inflation and price pressures, there is a belief among some that trade or global trade, the way it's been playing out, may not be playing the way they thought it would. And again, tariffs are a reaction, but I'm going to go deeper into that in a minute. Within inflation, we can look at different categories like goods inflation, services inflation, food inflation, energy inflation. And then within it, I can look at specific products as well. And one of the really fascinating elements about the US economy of late is that the goods inflation numbers is pretty much at 0%. So the price of goods are not rising anymore. They were during COVID. Price of goods, things like washers, dryers, cars, clothing, etc., were rising by 12% a year. Now that number's pretty much come down to 0% a year. So goods inflation at this moment in time is pretty good. It's in a good spot. Services inflation, though, which is what you would otherwise construe as an experience, eating at a restaurant, going on vacation, tourism, travel, etc., that's running at 3.6%. So that's still fairly elevated, and that's what's causing overall inflation to not fall below 2% in this moment of time. So the key takeaway I want you to think about here, though, is that Goods inflation was a problem during COVID globally. Goods inflation today is fairly normal. It's at 0%. That means prices of goods aren't rising. But these are all before the effects of tariffs have come into the economy. And so that's yet to come. And so we're not yet seeing the permutations or the effects of tariffs yet on goods inflation. And I'll talk about that in a bit. Consumer spending has fallen off a little bit. And so consumer spending is a really important conduit for growth in the US economy and in the global economy. So historically speaking, consumer spending was a really big driver of economic performance here in the US, and consumer spending was doing well. Even during COVID, we found that consumer spending was doing well because people were spending quite a bit on retail goods. Consumer spending in the toward the tail end of last year and the beginning part of this year has started to come down. It's a natural phenomenon, but again, this is all before COVID. So we are starting to see a slight slowdown in consumer spending, but it's still positive. Business spending is another category that's been doing really well or was doing really well. It's come down a little bit, but it's also been a tailwind in the economy. And I'm pointing these out because when we think about economic growth, GDP, we look at what the consumer is doing, the business sector is doing, what the government is doing, and then ultimately what's happening with the net trade, which again gets us to the tariffs conversation shortly. So the point here is that up until throughout last year, the US economy was doing quite well. Consumers were spending, the business sector was spending, and so overall that was becoming a tailwind for economic growth. But we're going to talk a little bit about what we think will happen going forward. And now all of a sudden in the first part of this year, what we're finding is that pessimism is starting to rise. So there's different pollings that we can look at, economic polling. University of Michigan is a really famous one. And what the University of Michigan has shown through their polling is that consumer sentiment is deteriorating, and consumers think inflation may turn right back up around. So as I mentioned, inflation has come down to 2.3%, but the University of Michigan polling suggests that most Americans think that inflation is going to go up to 7%, which is a really big number. And the reason they're thinking this is because of everything that's been going on with tariffs. And most people think that tariffs could raise inflation. And that's a natural way to think about this because it's an increase in prices. Economic uncertainty is also starting to rise. People polled through different mechanisms are saying that they're worried about policy, and tariffs as an example of policy. What's been happening, at least until recently in financial markets, the potential for inflation to rise again, household finances, all of these collectively are coming together and they're raising anxiety levels in terms of what people think will happen with the economy this year. And when that happens, what you typically worry about or think about is that does that then mean the consumer is going to start to pull back? So as I mentioned, consumer spending was doing really well. So if anxiety and pessimism and all these things are starting to rise, then will consumers start to pull back on spending? And will businesses start to pull back on spending? And if so, does that then become a headwind for economic growth? Interest rates were also moderating last year. So when inflation rose because of COVID, interest rates went up. The Fed raised rates, and then when inflation started to moderate last year, in September specifically, the Fed started to raise rates. So the recent high in the Fed funds rate, the main benchmark interest rate we look at here in the US, was 5.5%. And then over the course of a few months last year, the Fed lowered it to 4.5%. And the expectation was that over the course of this year, the Fed would further lower it to 3.5%, and then they would probably stop there. And 3.5% is a really good, interesting number to think about because it's not too low, it's not too high. And also, it happens to be coincidentally where US interest rates have averaged over the last 40 years. And so that was the expectation. But now, as many of you probably know, the Fed is on hold. The Fed has stopped the easing price process, and maybe they'll cut further later this year, but there's some uncertainties around that. And a lot of those uncertainties stem from will tariffs cause inflation to go higher? If it does, then the Fed is going to have to rethink about what they want to do with monetary policy. Do they want to raise rates or keep them flat? But if we find out that tariffs were not inflationary, then maybe they're going to want to continue to lower them. And then they also have to think about the economy. Is the economy going to slow on the back of this? And if so, then they also have to think about do we want to keep cutting or stay flat or whatever other policy metrics they want to think about. So it's one of the reasons because of the uncertainty factor right now that the Fed's on hold, and we have yet to see when they will start to move further. So now I want to shift to tariffs and what exactly is happening with tariffs. But to really appreciate the tariff policy, I always want to ground ourselves in thinking about, well, why are we here? What was going on over the last 40 to 50 years that's led us to this point? And there is a really fascinating story to think about. So one of the trends was that in the 1970s, US goods inflation, again, just goods, so washers, dryers, clothes, cars, etc., started to rise. And recall that 2% number I talked about, that we want to keep it around 2% or lower. Well, in the mid 1970s, goods inflation was up to 12%. Prices were rising quite a bit. There was a few reasons for this, but one of them was that American wages, labor costs were rising quite a bit. So manufacturing was going up, and then the end user had to pay for it. And that happened throughout the 70s. And then by the time you get to the 1980s, goods inflation starts to come down. And the reason it's coming down, though, is because a lot of American businesses during this time period are starting to manufacture in foreign markets, specifically in Asia. It's not China at this moment in time, but it's other markets like South Korea, a little bit of Japan, and Indonesia, Hong Kong, Malaysia, Thailand, Taiwan, markets in Asia that can manufacture products because of their competitive advantage in labor costs. They have lower labor costs relative to their American peers, and they can do it well. And goods are being made and they're being exported back to the US. And we can see the effect of it, which is wage inflation, or sorry, goods inflation starts to come down close to zero throughout the course of the 1980s. And this process is very common. What we often find in economics is that there's this product life cycle, which is, just for an example, a VCR may be made in Japan in the 1950s, and then eventually wages in Japan get too high. So then they start moving to other markets like South Korea, and then wages in South Korea get too high, and then the VCR is made in Malaysia and Indonesia, and then eventually India. And it's what happens in global economics. And that's what's playing out here in the 1980s, which is product is being made in overseas markets because of the competitive advantage of the labor cost. And as a byproduct, the price increases start to moderate. And so goods inflation starts to come down to 0%. And then by the time you get to the early 1990s, then another development takes place, which is the end of the Cold War. Cold War ends, Soviet Union collapses, the global order shifts, and the US in part reacts to this by reaching out to China. And this is the time period where the American government is saying, we want to work with China. We want to help build the Chinese economy. And they start encouraging a lot of American businesses to start manufacturing in China. It's a foreign policy and an economic policy imperative. And China responds by saying that they want a lot of this business to come to their country because they want to create jobs for a lot of their people. And so throughout the 1990s, there's a new wave of offshoring that starts to take place predominantly to China. And you can see the effects of it, which is goods inflation comes even further down. And then for the next 20 odd years, goods inflation is running at close to 0% on average. And then you have a spike again in 2020, which is the COVID era spike. And this was because of the supply chain breakdown, which I'm going to talk a little bit more deeply about in a minute. And goods inflation goes right back up to 12%, and then it comes right back down shortly after. But there's two takeaways here, which is in the 1970s, the reaction to the spike in goods inflation was to offshore, engage in free trade, liberalize trade, make things in foreign markets, ship them to the US and to other markets. And this era of global trade, free trade, globalization did help reduce inflation. However, the reaction to the COVID era inflation spike, we believed when it was happening, and we said this, is going to be the exact opposite. There's likely going to be a belief that supply chains got out of control, that we lost control of production, and therefore we want to nearshore, friendshore, or onshore production, meaning bringing some of that production back into the US. So that's the sentiment behind tariffs. Tariffs are the byproduct of it, though. Global trade, just to go deeper on some of these points, global trade did rise throughout the 80s and 90s, and that's what this chart is showing you here. We can look at global trade from a dollar value basis or also from a trade to GDP basis, which is what these two lines are showing you. And you can see the run rate is that from the 1980s onwards, global trade did in fact rise, both in dollar terms and as a percentage of global GDP. And again, just to reiterate the point, this was the byproduct of offshoring, globalization, manufacturing all over the place. And one of the benefits is that global trade went up, international commerce went up, the maritime industry became more and more paramount. But at the same time, yes, supply chains did get more complicated because sometimes the production lines were complex and straddling across different countries. So again, this desire to offshore and bring costs down did result in global trade to go up, which then opened up new shipping lanes and new trading relationships around the world. And just to take this point a little bit more closer to what happened with the US-China relationship, this line, this red line here shows you the percentage of goods coming into the US that come from China. And in the 1980s, the number was pretty much zero. There was not a whole lot of connectedness on an economic basis and a trade basis between the US and China. And then, as I mentioned, it was around 1990 where that offshoring wave was shifted and started to move to China, given the collapse of the Cold War and America and China's desire to increasingly work with one another. And throughout the 1990s, the percent of product coming into the US from China rose from almost zero to around 22.5%. And we can just say 25% roughly. So by the year 2018, almost a quarter of everything coming into the US was made in China. And that's the byproduct again of the decades plus of offshoring and globalization and so forth. And it's around that time period, though, that the first round of tariffs went into place. So we're talking about tariffs today, but if you recall back to 2016, 2017, the US administration at that time also implemented a series of tariffs, and they weren't nearly as high as what's being discussed now. At that time, the US government took tariffs on China only from a roughly 3% to 11%. And that was a big deal at the time. And again, those were only on China. They were not on other countries, and they were not on all products around the world. And the reason they did that, one of the reasons they did that was because of this chart right here I'm showing you, which is a lot of product coming into the US is coming from China. Now, there were other reasons too. There was national security reasons cited. There was a desire to protect certain US businesses. There was a tax argument made forward, but that's what was implemented in 2017. And shortly after that, what we found is that the imports coming into the US from China fell sharply. So from around 25%, so again, almost a quarter of everything coming into the US came from China in 2018. That number fell to about 12.5% by the year, by as of the most recent year. And it's actually come even further and it's below 10% now. So if you're looking at this, you would think that, well, it seems like the 2017 tariffs worked. If the goal was to de-link the US from China and to reduce imports into the US from China, then evidently, if you just look at this one chart, you would say that it worked because the US cut its imports from China in half. However, what's not revealed in this chart and what is not otherwise discussed, but is very important, is that China's exports to the world didn't go down. They actually kept going up and stayed kind of flat in some cases. US imports also didn't go down. So if China, the world's largest manufacturer and exporter, is exporting as much, if not more than before, and the US is importing from the world as much, if not more, then where's that difference coming from? Is China somehow selling these goods to new markets and America's buying goods from new markets? The answer is no. What likely started to happen instead is that a lot of that production shifted to other markets, but was still, in many cases, originating in China. So here's this graph right here, which shows you the differential between the amount of imports coming into the US from China versus Mexico. And sure enough, the China number, as I said, went up, and then it came down to around 12.5%. Meanwhile, the imports from Mexico steadily increased right around that time where the Chinese imports from China are starting to fall. And what we believe started to happen around this time period is that in some cases, a lot of product made in China was just transited through new markets. In some cases, it may have been finished in new markets and then moved along. And maybe in other cases, the entire assembly line did shift. But but the origin was still in many cases China. The difference, though, is that trade started to disaggregate. So a couple of takeaways here. One is, yes, U.S. imports from China fell, but U.S. imports from Mexico rose. So U.S. was still importing just as much as before. Second takeaway, we believe a lot of that product was actually originated in China, but just rerouted through new markets. And case in point is this chart on the right, which shows you truck border activity. And you can see right around that 2017 time where the tariffs went into place, all of a sudden the number of trucks crossing the border from between US and Mexico started to rise. So it's not believable that overnight somehow Mexico made a lot more industries that were exporting to the US. Instead, what we believe happened is that a lot of those goods were being transited through Mexico or Vietnam or other markets. So that disaggregated trade that was beneficial to some markets like Mexico and Vietnam again, which started to pick up that trade. It rerouted the maritime industry, it rerouted shipping flows, rerouted economic linkages and the global order in many cases. But at the end of the day, the US was still importing heavily. It's just that seemed like it was coming from new markets. This is one of the reasons why we believe this time around in the administration, the US administration is now targeting a lot of countries on tariffs and products, because we believe that there is a belief that country tariffs can be evaded, as evidenced by these two charts right here. So instead, it seems like the US government is saying that they want to start to tariff many nations to maybe plug some of these holes and to close the gap where some of those openings may have emerged. So one of the goals of tariffs is to reroute trade and to ease U.S. dependence on certain markets. And the way they're going about it, the way the government is focusing on it, is by raising the tariff on countries and products. And the goal for this is to make other countries bring down their tariff rates or to, again, reroute trade in many cases. There's a mixture of different objectives here. So what I've put here for you is just what average tariffs were in different countries. So for example, for a number of years, Canada maintained a tariff rate of around 4% on all products, food and goods. China had an average tariff rate of around 10%, which came down to around 8%. India's consistently maintained relatively high tariffs, which were in the most recent year around 17%. So yeah, a lot of countries do have high tariffs or elevated tariffs, and the US historically was much lower. Average US tariff was roughly 3%. But now that number is going higher, and this number is already a little dated. I put here that the average US tariff is around 10%. It keeps moving around. It really depends on the different shifts in policies or what's being announced. But there was a point in time where we were calculating that the potential average US tariff would have been even higher, maybe even 24 or 25%, which would have made it higher than most other countries. But just to reiterate the point, most countries do have tariffs. The US also had some level of tariffs in the past. But what we're now looking at is a potential increase in that rate, and the goal being to force other countries to either bring down their tariff rate or to change how global trade functions. And again, the public statement from the US government is ultimately a goal of bringing some of that manufacturing back into the US. So this chart just shows you some of the tariff rates on the major countries. As I stated earlier, because of the reorientation that we saw after 2017, two markets that the US first started to announce tariffs on beyond China were Canada and Mexico. And again, as I mentioned, the goal likely was to plug some of the gaps to make sure that trade didn't go to these new markets. So right now, the numbers we're looking at is 25% tariffs on Canada and Mexico, but that only applies to roughly half of the goods coming through those markets because of something called the USMCA, which is the trade agreement, the new version of NAFTA. So anything that falls out of that trade agreement will not be taxed, will be taxed at 25%. Anything in that trade agreement will not. Then you got the 25% auto tariffs, 25% steel tariffs. There's the 10% tariffs on most countries with a 90-day pause. Those could start to go higher after those 90-day pauses if trade deals aren't struck. There could be some tariffs on the way on the semiconductor sector, the pharmaceutical sector. So there's an assortment of tariffs. Now, specifically on China, as most of you are probably aware, the tariffs on China were sequentially raised. So we started the year at 11%. They were raised by another 20, so taking them to roughly 30%, then to around 50, then to around 125, and then ultimately they were raised to 145%. And China responded by putting its tariff rate up to 125% on the US. Since then, those rates haven't come down. And the big announcement over the last 2 weeks was this temporary US-China pause. So the US has announced that it's going to bring down those tariff rates to roughly 30%, and China brought their numbers down to roughly 10%. However, the caveat here is that it's a temporary pause. So if in the next 90 days a formal trade agreement isn't really worked out, then these numbers could go right back up again. So yes, they're lower in this moment of time, but they could go higher. What we started to see in the first quarter in the run-up to these tariffs, as businesses were planning for them, there was a surge of imports that started to happen. And this is a natural phenomenon. Everyone knew as of around February, March, that tariffs are on the way. The announcement dates were put out there of roughly April, May, and so forth. And so a lot of businesses started to get ahead of this by buying a lot of goods to build up their inventory and restock their inventory to avoid the tariffs when and if they came into place. And I just put up some numbers here of different import flows. And the biggest was what started to happen with industrial supplies and consumer goods. They started to rise quite sharply as people and businesses were trying to get ahead of tariffs. One of the cause and effects of this, though, is that when you see a surge of imports and you get a widening of the net trade, of the trade deficit, then that becomes a headwind to economic growth from a GDP calculation standpoint. And so that's one of the cause and effects of this, which is Businesses thought tariffs are coming. They started to increase their imports. And that's one of the reasons, not the only reason, one of the reasons why the US economy contracted in the first quarter. So now I want to address some questions about supply chains that I get asked a lot about, which is, are these tariffs going to break the supply chain? And to answer this question, I like to explain, well, what happened during COVID? And again, these questions usually stem from, is this going to be like COVID all over again? And I always like to point out that during COVID, there was a really specific set of circumstances that came together to break the supply chain. First is that there was a supply shortage. So a lot of manufacturing centers around the world and in Asia stopped producing. And the reason they stopped producing is because labor couldn't get to the workplace. Lockdowns happened, factories were shut down, so nothing was being made. Quite literally, a shutdown of output. The second thing that happened is that there was a reallocation of production in some cases. So we look often at the auto industry globally. So when lockdowns started to happen in 2020, the auto industry, which historically used to buy a lot of semiconductors, stopped buying semiconductors because they thought nobody was going to want to buy a car. So they started drawing down their manufacturing, their production. And shortly after, demand for cars picked up and there weren't enough semiconductors available for that industry. So there was a reallocation or a misallocation of product, which led to some supply shortages as well, exacerbated it. Third thing that happened is we had a maritime disruption. A lot of ships were in the wrong part of the world. Some of the containers were in Europe. They needed to be in China. And so there was a breakdown in the maritime sector. The fourth is we had a labor disruption. It was around this time, at least in markets like the US, UK, and Germany, we started to see a pickup in retirements because people started to leave the workforce. And that meant in some cases, like in the port sector, there wasn't enough labor to take containers off the ships. Fifth thing that happened is in a lot of big consumption markets like US, France, Germany, and UK, savings rates started to rise. Household savings rates got really high. And the reason they got really high is because nobody was going anywhere. So they started saving money, and then that money was funneled and channeled into the purchases of goods, not services, but goods, because everybody wanted to buy stuff when they were sitting at home. And the sixth thing that happened is because of the recessionary fears, central banks, including the Fed, cut interest rates. So you had a situation where people had money and the cost of capital was cheap, so they could borrow to buy expensive items, which were either not being made or not made in enough quantity, and then weren't showing up in time because of the shipping dislocation. So this was really a unique set of circumstances. And so, contrary to what people thought would happen, consumption actually kept rising while product was not available. It was a perfect storm. And one of the charts I'm showing you here is what started to happen to new vehicle and parts inflation in the US. New vehicle inflation went up to around 12%, and used vehicle inflation, which is not even on this chart, went up to around 45%. So the price of used cars was rising 45% a year because there was just so much demand for this product, the car, which just wasn't available, and yet a lot of demand for it. Household savings rates, as I mentioned, got really strong. So in America, for example, people save about 5% of their income. That's historically been the number. That number spiked during COVID to almost 35% because nobody was going anywhere. And so that fueled a lot of demand because people had money. We track something called excess savings, which is how much money do people have above and beyond the pre-COVID run rate, and that number started to rise as well in terms of aggregate billions of dollars. So it was a huge number there as well. Now, both of those numbers have come down. So you can see excess savings is down, and even the savings rates is lower. So I bring this up because the consumer is weaker today than they were during COVID. So this is a dampening effect when it comes to demand of goods. If tariffs are inflationary and prices of goods start to rise, unlike COVID, it's likely that the consumer will pull back, and that could have a moderating effect on prices and overall supply chain dislocation. Inventory levels are also much higher today. So you can see on this chart here, which is the dollar value of overall inventories, and it's much higher than during COVID. Up until COVID, there was a business mantra of just-in-time delivery, which is run thin inventories, keep your costs low, deliver goods as people need them. And post-COVID, that mentality seems to have shifted, where there's a run-up in inventory levels. Now, if there is a supply chain breakdown or if there is a shortage of goods that persists, then of course this inventory level will get drawn down. But I'm pointing this out because at least in the short term, if there is a dislocation location of goods availability in certain markets, this buildup in inventories should help mitigate some of the potential shortages, at least in the very near term, because you want to draw these inventories down before you truly face shortages of goods in select markets. The other thing we track is what's been going on with shipping. A lot of headlines over the last few weeks about fewer and fewer ships set to arrive in certain ports, and that's an indicator of a supply shortage issue. And it's partially true, but there's some other elements to think about. Specifically, when we look at this, we want to see what ships are coming into the US, but we also want to see the number of ships leaving China as an example. And that's what this other chart shows you, which is how many ships at any given time are leaving China headed for the US. And there was a huge run up right before tariffs went into place, and that number has come down. But the key takeaway is that, and people often say, look, the number of ships leaving China is low, but it's a very volatile number. And you can see that A, it's not much lower than what it was last year in 2025 around this time. And B, it is starting to go back up. And then in more recent data, as of today, shows that it came a little bit back down again, but it's a little range bound. So I'm not trying to tell you that the number of ships leaving China is really big. Yeah, it's come down, but it's not zero either. It's still running above or at where it was roughly last year. And so that tells us that product and shipping activity is maybe weak, but they are leaving the ports and they are leaving the markets. And again, I pick this up because we get asked, are there going to be supply shortages or empty shelves? And the answer is maybe in some cases, but it likely will not be like COVID entirely. And when it comes to the cost of moving goods, which is a key ingredient of inflation and as a barometer of risk in the logistics sector, before COVID, it used to cost roughly $2,000 to move a container, a 40-foot container from Shanghai to LA. During COVID, that number got to $12,000. And that's because of the breakdown, as I mentioned, in the logistics sector, in the maritime sector, and the availability of labor. A lot of demand to move good and not enough ships to move them. That number came down. It popped up again around the Red Sea issues when the Red Sea was closed because of the Houthi attacks. But right now, it's running at close to its pre-COVID level of $2,000. Now, this might be because of a slack in demand, but overall, what this tells me is that there's no breakdown in the maritime sector, at least, that there is ample supply and capacity to move goods if and when, and the cost is not really high either. So this cost in itself may not be passed on to the consumer. So overall, this time is not like COVID. That's an important takeaway to think about, that there is a weaker American consumer. You don't have the distortions in labor. You don't have the shutdowns, and capacity in the logistics and maritime sector is not doing what it did during COVID. But there are risks to consider. One of them is that supply chains remain very complex. So yes, there is a possibility that in some industries, the downstream part maker or buyer doesn't have it available. There is other issues in terms of concentrations being high, and geopolitics is also a risk because in some of these trade war back and forths, what we found, for example, China responded by briefly halting rare earth mineral exports, which could then, of course, affect supply chains and key certain parts of the economy. So I'm not trying to say again that everything is normal or that it will be normal. I'm just trying to draw a distinction between now and COVID. Ultimately, though, tariffs are a tax of sorts. And so they could be inflationary. They could raise the price of goods. And in turn, the consumer may pull back on the purchases of some of those goods. And now I want to close with how tariffs and geopolitics are coalescing with one another. So as I mentioned, tariffs are being raised. They could result in some countries lowering their tariffs. But what we also think will happen is that it may reorient how trade flows. And one of our beliefs is that if you see a reorientation of trade flows and you see new linkages emerge between nations from an economic and trade standpoint, other geopolitical developments can transpire on the back of it. Nations that are economically close, that have trading relationships, tend to also, not always, but tend to have geopolitically close alignments as well. So to give you a couple of examples, if you look at the top right chart, this is the percentage of imports coming into Russia from China. It's gone up from around 10% on average to suddenly up to around 45 to 50%. And one of the reasons for this is because a lot of the world doesn't trade with Russia after the Russia-Ukraine war. So Russia has increasingly turned to China because of their border and their economic trade partner relationship, and China is now responsible for a lot of the product that's ending up in Russia. That economic relationship can translate into a geopolitical one as well. India's imports from Russia have also gone up. A lot of this is oil and gas. Historically, India and Russia have had a close geopolitical and foreign policy linkage, but now it's also translating into a very evident trade relationship as well, which makes Russia even more proximate to India. So again, repeat the point. When you start to see a realignment of trade, you will likely also see a realignment in geopolitics, which is why we believe that tariffs could spur along reshaping of the world order. As this is happening, US-European ties are already pretty fractious. There's a couple of reasons for this. One is tariffs again. The US did impose tariffs on UK and Europe, and the US and UK announced a trade deal, but tariffs are still very much in place on Europe, or they could go up further. Second is a lot of the defense commentaries. So the US has historically provided significant security to Europe via NATO. But the US government is now saying that they want Europe to start to raise their defense spending in order to meet their NATO obligations. And it's becoming a bit of a sticking point. But just take a look at what has been happening with defense spending around the world. The US in dollar terms remains a very big defense spender at around $900 billion, followed by China at around $300 billion, and then Russia, India, Saudi Arabia, and UK, and some of the other European markets spend around $70 billion a year. So that's nominal terms. But if you look at the growth rate in spending since 1994, China's percentage growth, their growth in spending on defense is up almost 2,500%. And Russia's is up next, and then India thereafter. So even though in nominal terms, some of these countries aren't spending a lot, their growth rate has been on a really strong trajectory, much higher than what's been happening in the US. But keep in mind, with countries I just mentioned, I said China, Russia, India, Saudi Arabia. Comparatively, the growth rates in traditional US allies in Europe, like UK, Germany, France, the growth rate's not as high. On top of which, as a percentage of GDP, their number is not that high in many cases. So this is becoming a sticking point between US relationship with Europe. Now, consider against that, though, that there's also something we refer to as fiscal pressure, which is a lot of the European nations have really high debt to GDP. And so they're not yet in a position to raise their defense materially. If they do, then they may have to issue more debt, or they may have to pull back on spending on social security or social services or pension spending or other parts of the social safety net they've built around their societies. And this is a really hard decision for them to make. So you have a situation where Europe is being asked to spend more on defense, all while they have headwinds, fiscal headwinds. And meanwhile, countries in Asia, like India, Russia, Saudi Arabia, China, have lower debt to GDP ratios, strong economic growth in not all cases, but many, and they can spend more on defense than they are. And so you've got the NATO pressures, and then you also have tariffs. And this is one of the reasons why Europe is increasingly becoming vocal about some of its frustrations with the US. And these are just some headlines I pulled recently about what Europe's leaders are saying and what they're thinking about doing. So where this is headed, where we think this may start to go, is that as the US-European alliance starts to fray because of the defense and the tariff element, some of these European nations may start to look towards new partners for economic and ultimately defense relationships. India is a country that comes to mind because India and Europe does have close relationships. They have common security beliefs, and the Europeans are looking to sell more defense equipment to India as an example. Germany may look more towards China to sell more of its manufacturing product out there. Some of the cars that Germany makes, they may look to sell more into China and into new markets. So to close, where we think some of this tariff commentary may head, or the direction, is that it may start to exacerbate the pressures of not just global trade reorienting, but also geopolitical lines resetting as well. Okay, so I'm going to close there. I appreciate it. Hannah, I'm going to hand it back to you, if you don't mind. And if there's some questions, I'd be happy to answer them.
Okay, thank you so much, Shailesh, for your really brilliant presentation and for so many of the charts that I think were really, really illuminating, to talk about consumer spending, tariffs, and, even defense spending. So a lot, a lot of information that I think will be very, very useful for all the attendees on the call. Well, we'll give it some time for questions to come in, but before that, I think, have prepared some, so we can get the ball rolling for Q&A. I think we can begin by exploring the foundations and the foundational economic dynamics. I think that you mentioned throughout this call. I think my first question is, will you be able to share your thoughts on the link between trade deficit as well as fiscal deficit? Yeah.
Yeah, yeah, definitely. It's a good question. I think a lot of times those two topics get interchanged. In the media in particular, you may often hear about the fiscal deficit driving the trade deficit and vice versa, trade deficit driving the fiscal deficit. I think it's really important to unpack what they are. They really are two separate things. The trade deficit is, as it implies, how much are you importing versus how much you're exporting, goods and services both. And that in itself is an important distinction to make. Goods, as I've mentioned in the past, goods are physical products, but services are the following. So, for example, if a tourist comes to America, to Disney World, and spends money, that's actually considered a service export. And the reason it's considered a service export is because that foreign citizen who's visiting the US got an experience in the US and then they spent their dollars here. So we exported them a service and we received money in return. So tourism is a services export. Google, Facebook, Visa, MasterCard, all these companies that provide services, financial services or intellectual property around the world, that's also all considered services export. Medical, legal, financial services, that's all services export. So goods and services both make up the trade part of it. How much of it are you importing versus how much of it are you exporting? And the gap is the trade deficit cumulatively.
Yeah.
The fiscal deficit is how much is the government raising in taxes from its own people and other sources versus how much of it is it then spending. And the difference there is called a fiscal deficit. And every year, if you run a fiscal deficit, you keep adding to your total debt. Again, two separate things, but where they sometimes collide with one another is there's a belief, as I mentioned earlier, one of the ideas is that, well, because the US is running a trade deficit, then maybe it should tax the trade, tariff the trade to raise revenue to then plug the fiscal deficit. So that's sometimes where the connectivity starts to come together. But otherwise, they are generally two separate things.
Okay. Cool. Thank you so much for answering that question. And I think building on this, these macroeconomic connections, or as you say, the evolving landscape and how the dynamics are changing, what do you think are tools that other nations have available if you think this trade war will escalate?
Okay, good. Yeah. So continuing with what I was just mentioning about goods versus services. So the US runs a goods deficit. We in the US and a lot of European nations similarly import more goods than they export, and a lot of markets in Asia export more goods than they import. That's generally how global trade currently has been structured. However, what a lot of US, Germany, UK, etc. do really well is they export services. So US again runs a services trade surplus. So we in the US export more services than we import, just given the nature of the economies. And so a lot of the trade war conversation so far has been focused on goods
Yeah.
and raising tariffs on goods and how other nations are responding on goods. One of the elements that we think about is could this then, if it continues to go the way it is, or if it worsens, will countries may potentially start to respond by tariffing services, US services, or maybe making it more hard for services to compete around the world? And I gave you a couple of examples earlier. I mean, it covers financial services, it covers legal, tourism, medical, etc. So that might be an area just to keep an eye on. I don't have a definitive view on it yet. We're not yet seeing the signs of it. But
Yeah.
but if other countries wanted to retaliate, that would be an area that they may look at.
Okay, thanks for that. I see that we just have a question coming in, so I'll read that out now. And this question is from Radia, and she asks, coming from the insurance industry, so we go back to consumer spending on one of the slides earlier. How did consumer spending behavior, especially post-COVID, influence the demand for various insurance products, such as travel, life, health, and perhaps home insurance?
Yeah, I'll try to answer this. I mean, it's a little challenging because we're as economists, we target consumer spending in the economy. And then what that translates to from insurance needs is a little bit different. So I can't fully comment on that. But one of the things we started to observe right around COVID is that there was, as I mentioned earlier, there was a spike in goods demand. And so 2020, 2021, people couldn't go anywhere. So we started to see a pickup in goods demand. So a lot of goods purchases were starting to happen, which put pressure on shipping, the cost of shipping, the movement of goods, the logistics sector, the trucking sector, demand for trucking. So those are all areas that were flourishing. I can't fully comment if that translated into more uptake of insurance coverage for those lines. I would assume yes, to some extent. But that's what we started to see because nobody was going anywhere. And so that's what the behavior was. As soon as lockdowns ended, the demand for goods normalized. And then instead, we saw huge pressure on services. So it was around this time period where you may recall, I'm thinking about 2021, 2022, where all of a sudden there was a surge in demand for airline travel. And a lot of the planes weren't available because a lot of airlines had put them in protection, but they weren't flying them, but they kind of put them in a warehouse, not literally, but figuratively. And a lot of pilots were not available. It, so during this time, a lot of demand suddenly to travel, not enough planes, not enough pilots, airfare started to go up. And that caused a dislocation. You saw that happen in other parts of the service economy as well, around the board, or across the country, or across the world. So again, I can't perfectly answer to you if that led to a direct uptick in coverage demand, but I can definitively tell you that these shifts in consumer behavior did put pressure on the US and global economy in different ways.
Okay, thank you, and hope that answers your question, Radia. And for anyone else with any thoughts or comments or questions, keep them coming in. I think for now we can gear back to our discussion and conversation earlier, which we were talking about trade wars, right? So, I think now that you mentioned various sectors being affected, more positively, what do you think are some sectors who are poised to perform well, now that the regulatory environment, geopolitics are changing, yeah, in this landscape. So are there any sectors you think will do better than others?
Yeah, we're generally quite bullish on the advanced tech, advanced manufacturing. And specifically, I'm thinking about artificial intelligence, cloud, data centers, semiconductor manufacturing, etc. Because that's where a lot of demand is headed. We often say that anything that's geopolitically sensitive may be poised to do well. Defense is another area, for example. But why I'm pointing to advanced manufacturing is because in a lot of countries where there's a desire to increase manufacturing, the reality is that wages are way too high. In U.S., parts of Asia, parts like Singapore,
Yeah.
or in Germany and UK, where making toys, for example, not be realistic. Making clothing in these countries may not be realistic. However, you have a high skilled workforce with high wages and a lot of engineering capabilities. So that's where we believe as the shift starts to play out, you may start to see a greater demand for advanced manufacturing in a lot of these markets. So that's an area we look to with a lot of potential upside from an economic standpoint.
Okay, and what about, on the flip side, right? Will you think more sensitive sectors, maybe such as semiconductors, will they fully, maybe relocate, or what are some implications you think, yeah, more sensitive sectors will
Yeah.
face?
So again, semiconductors we are positive on from a growth standpoint because of the demand of AI computing. What is challenging in semiconductors, though, is as you alluded to, the movement of the industry. A lot of it right now, from a manufacturing base, fabrication base, as they say, is based in Taiwan. And there is a lot of pressure increasingly to move it. And there is a lot of, for example, here in the US, a lot of development, construction activity around building fabrication centers. So it is happening. The difference, though, is that it may not happen immediately, and B, some of the more advanced semiconductors in the near term will continue to be made in Taiwan because there's an ecosystem built out there, and there's a knowledge base and a capability capacity. It's a very tough industry to just figure out overnight. So some of it may move offshore, but some of the more high-end semiconductors, the really, really thin, small semiconductors, will continue to be made in Taiwan because of the challenges in making them. Other industries that we think about from a complexity or where is it headed standpoint, um, as I mentioned in my comments, global trade is going to continue. It's just that the routes may change. And so we think a lot about in the maritime industry, what's going to be the new conduit? Are we going to see the LA Shanghai trade route being the dominant route of the next 10 to 20 years? Or is it going to be some other city pairing? And if so, are shorter voyages going to be the common thread? Shorter voyages with bigger ships? And I haven't figured it all out, but this is an open question. And well, what does that mean for the maritime industry, and what does that mean for coverage going forward? So that's something to think through. The others is what does this mean broadly for logistics, warehousing, trucking, the movement of goods? If we are entering a world where goods demand starts to shift or look a little differently, then is that going to affect some of these parts of the global economy?
Right. I think okay. So now I'm conscious we have about 4 minutes left. On this, looking ahead and talking about the economy. What do you think are maybe final thoughts or emerging trends that we should, leave with the key takeaways? Should leaders and policymakers, think about or prioritize, as we navigate this, evolving economic landscape. Yeah.
Yeah, I think the important takeaway is that this is a topic that's going to be around.
Yeah.
We'll continue to see volatility in the headlines. We'll see news of tariff rates coming down, trade agreements being made, but it's not over. And in all likelihood, tariffs may go. I don't know if they will definitively, but they could go back up. That's a risk. But some form of tariff are likely here to stay. And then ultimately to think through, well, what does that mean for inflation? What does that mean for consumer demand of goods? How does that shift purchasing power, purchasing behavior? Do people start to buy different kinds of products, cheaper products, more locally made products? So there's a lot more to unfold here. I think policymakers will likely think through that. I think there's a question then about, as I mentioned on the inflation topic, what does this mean for monetary policy in the near term as well? Um, and then, as I alluded to earlier, how may nations eventually start to react? Will they start to think about some kind of challenges to the services trade globally? And then finally, going back to what you see on the slide here and what I closed with, which is the longer term geopolitical implications. I mean, if we're entering a world where tariffs start to upend trade, then how does that affect how nations work with one another?
Okay, thank you so much, Shailesh. I see that we have one last question in the last 2 minutes. So would
Okay.
you be okay? I'll go through that one
Yeah, of course.
question.
Yeah.
Okay, so I guess the final question here goes back to, talking about maritime and also linked to maritime sector. So what role does maritime insurance play in managing tariff-induced disruptions?
Yeah, again, as an economist, it's really hard for me to answer that. That's something I would recommend
Yeah.
folks who are in the maritime underwriting space to potentially address. I can just tell you, going back to the comments I made earlier about if you start to see the emergence of new trade routes opening, that may open up coverage demand in certain areas and may affect, if you see the duration of shipping activity start to change, it may affect coverage demand or pricing. I can't fully speculate on how. It's hard for me to also tell you how the maritime sector could help mitigate tariffs, because at the end of the day, tariffs are policy. They're decided by governments from an economic policy standpoint, and they're done via their respective entities, like the Treasury Department or the ministries of finance of countries. The maritime sector then follows through. So if there is a tariff and then there's an economic change to the world order or how shipping happens or where shipping takes place, then the maritime industry is affected. So that's typically how I see the process playing out. But beyond that's kind of hard for me to answer.
All right, thank you so much once again. I guess yeah, we will kind of end the call here also, and now I will actually post the feedback form. So if for everyone still on the call, if you have any feedback or comments, if you really like the presentation, just like I did, then fill out the feedback form, and then we will recognize the 1 CPD hour as well. But once again, for Shailesh, we just want to thank you for this really outstanding presentation, and also for dialing in and so late at this hour from the US. So thank you very much
Thank
once
you.
again. Yeah, I hope you have a good night, and also for everyone, have a good day since we are early here in Singapore. So thank you, and then we'll close the webinar now at the end. So, okay, bye bye. Thank you. Thank
Thank
you so
you.
much.